After losing $231 billion in market cap in one day, the largest market cap loss of any corporation in stock market history, Facebook now looks really cheap. Or does it? Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the fundamentals analyzer software tool, also known as Mr. Valuation. You know, FastGraphs is a really powerful tool that can help investors make intelligent, long-term, prudent decisions by analyzing the value of a business in contrast to the price that the market is valuing its stock at. Now, what's interesting about that is if you look at Facebook today, Facebook, had one of the largest market cap drops or the largest market cap drop in history, Now, let's go ahead and analyze that and look at that via the FastGraphs Fundamentals Analyzer software tool. As you can see, since inception, the company's growth rate has been exceptional, almost 34% a year annualized. And using the Peter Lynch formula, P equals growth rate, we're drawing the fair value line on this historical chart at a PE ratio of 34. And you can see the stock actually tracked that pretty closely. And right now, the stock is trading at the lowest PE ratio that Facebook has ever sold at. Now, of course, it's called Meta Platforms, Inc. I'm going to refer to it as Facebook. It's just easier, if you don't mind. The bottom line is that the stock is trading one of the lowest PEs ever. But now, is that realistic? Does that make it extremely cheap? Or does the stock still have potential to fall? And to be able to determine that, you want to first of all look at the numbers, but then you also got to look at the company and think about the company itself. But when you're dealing with a tool like FastGraphs, it's a dynamic tool. It allows you to look at all these different time frames very quickly. Now notice when I switch this to an 11-year graph from its current graph, that I still maintain that 37% growth rate, because that's really, the length. But if I cut several years off of that graph, all of a sudden, it's now a 21.97, or we'll call it 22% growth rate. Now, the stock is still commanding a high PE. The blue line on the graph shows a normal market multiple of about 27 times earnings-ish, and these numbers are always ish. You can clearly see that a 27 multiple kind of, dissects the stock price line, high and lows over this time frame. But there are times when it got down to a 22 PE, because now this value line has dropped from a 34 or 37, whatever the number was, PE ratio, down to a PE ratio of 22. And you can see, it got pretty close to that, right here, and it got cheaper than that here, where the PE did get, down to 17 or so. Right now, we're looking at about a 16 PE, 16.14, lowest price earnings ratio for the company. But growth now has slowed down to 21%. Now, I take some more time off of that graph, and now all of a sudden we have an acceleration in growth again. And Facebook begins to look very, very cheap again. The stock price, here we're using a 27 PE. As you change time frames, the data changes. The mathematics is recalculated and you're getting a change. So you want to analyze the stock by looking at all these different time frames. But here's ultimately the key. Even though the stock looks very cheap here, this is the past. And this is what it accomplished in the past and why it generated the track record that it generated. And now all of a sudden it looks real expensive. But let's look at the forecasting graph. Okay. Now, first of all, the first thing I want to point out is the forecast growth is expected to be 17% on average for this year and next. It's a very flat year this year, less than 2% growth. 1.87, and then analysts expect this to get back to about 19.8%. And there are 35 analysts forecasting 2023 and 47 analysts forecasting 2022. Let's check that against Yahoo. I like to do that to get different opinions. And Yahoo is looking at earnings growth. They have 55 analysts for 2022 and 48 analysts for 2023, and they're saying $13.35 and then $15.84 for the next year. Okay, if you again compare that to the fast graph, we've got 14.17, 16.98. So the fast graphs, which get their data from FactSet, is actually showing, $14 and $16 instead of $13 and almost $16. Okay. The long-term growth, the 3 to 5 year growth rate next 5 years is expected to be 21.35% by the analysts following. That's from Reuters that are doing it. We've got 17.23. So our analysts have a lower number actually for the long-term growth. but those numbers are comparable. Okay, that's the point I want to get at. But I also want you to note that analysts 6 months ago were expecting for 2021 13.12, then they expected 14.18, and then they dropped it to 13.91, and it actually came in, at the 13.91. But for this year, we were saying 15.94 6 months ago, 14.48 3 months ago, and then now we're saying $14.17, and that number is still subject to drop. At this rate, though, the point is, assuming these numbers are correct, this stock doesn't look that cheap anymore. Now, I can go to the custom calculator, okay, on Fast Graphs, and I can put in a growth rate here of 23%, which is roughly what I showed you, with the analysts at Yahoo. And then, the stock looks pretty cheap at this rate, assuming it's going to grow at 23%. But now you have to figure that the company is obviously in turmoil. They had a really bad year. We don't know what the future is going to look like. There's politics, there's antitrust bills being introduced, and being fought over on these companies, on all these social media stocks now. So there's a lot to worry about with Facebook. The stock has certainly become more attractive, even using the conservative 17% growth that analysts from FactSet say. Then, the company looks like it's reasonably inexpensive here, but not dirt cheap. I do want to make that clear. The analyst scorecard on Facebook has been really great, except for COVID for 2019. They did have one miss there, but otherwise, the analysts have usually get this company correct, and that's partially, I think, because the company gives good guidance. But, there's a lot of uncertainty going on in the future here. Now, we've had this massive correction. This is certainly a lot better buy than it was, but given the uncertainties, the question is, has it become cheap? And frankly, looking at it from a standpoint of what the future might hold, it really doesn't look all that cheap here. It looks like it's finally maybe, you could buy it at fair value, but I wouldn't call it dirt cheap. So when you're using a tool like Fast Graphs, take advantage of all of the power that the stock has. Also look at the other metrics. Look at your cash flows. The cash flow story really tells the same story that we saw with earnings. Maybe it looks a little, cheaper based on cash flows, but we have good, solid cash flow growth, but you'll notice the cash flow growth slowed down and changed quite a bit, as well as earnings growth did with Facebook. If I look at EBITDA, very, very similar story, over 30% growth. And you can go through these, if you're a subscriber. You can look at EBIT, operating margin, and look at it, similar story, 29 to 30% growth. The sales picture, the price to sales, is very, very interesting. We had 32% growth in sales. You shorten that time frame, it's down to 24% growth in sales. Shorten that time frame a little more, it's down to 16% growth in sales. And if you're looking at forecasting, it's about 16.5 to 17%. All of these numbers pretty much corroborate a similar story and a similar growth rate. The question is, with all the uncertainty going on in these high-tech social media entities right now, what does the future hold, at least for the next couple of years? I think it's somewhat tenuous. Certainly, Meta Platforms, Facebook, is a better buy today than it was just a week ago. But is it still inexpensive and cheap? I'll let you decide yourself. But remember, there's a lot of work that needs to be done in this company to determine what's going to be happening in the next, subsequent quarters. In fact, it might be wise to see what the next couple of quarters bring before you want to take a position. Or if you want to be aggressive, you go ahead and take a position in it today. Facebook is certainly a company that's in transition and in flux. We don't know to what extent, but one thing I want to make clear, when a company gets to be over $1 trillion market cap like it was, growth is a lot harder to come by than when it was a $200 million company. They lost $230 billion plus in market cap in one single day. Most companies can't even dream about being that big, let alone losing that much market cap. So anyway, this has been Chuck Carnevale saying thanks for watching. Hope you enjoyed this. Hope you understand a little better after watching this on how to utilize a tool like Fast Graphs. Remember, it's dynamic. It allows you to do analysis. It doesn't dictate fair value, I like to say. It reveals it. It helps you determine whether values make any sense or not. So use the tool correctly, and it'll help you a long way. And if you're not already a subscriber, you might want to take a look at subscribing to it. If you like this video, ring the bell, give me a like, subscribe to the channel if you haven't already, and I look forward to talking again real soon. This is a bonus subscriber request Tuesday video, if you will, based on Meta platforms or Facebook. Thanks for watching.